Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to my weekly episode here on StockCharts TV. Hope you had a great weekend. We're recording this here on Monday, November 10th, as the S&P 500 and NASDAQ are rallying pretty aggressively after news over the weekend, hinting that we may be nearing an end of the government shutdown. Undeniably, I mean, if you look back at market history as a quick aside, quick rallies after the end of a shutdown, pretty common. I think the question is not going to be whether we get a tactical rally. I think that's pretty much safe to assume. The question is going to be what comes after that, because the economic data hasn't changed a lot. In fact, we haven't had a lot of economic data, haven't had a lot of inflation data or jobs data, and I think that could certainly provide a downside shock. So becoming complacent just because the shutdown is over, not something I would recommend. Certainly staying tuned in to StockCharts, remembering the message the markets provide back to us in the form of price action. So vital. Before we get to today's topic, and today what we're going to do is talk about tariffs, not about the macro threat of tariffs, not about how they've impacted stocks or not. We're actually going to be looking forward. Wells Fargo put out a piece recently talking about 10 stocks that they identified that they thought could do well if the tariffs were unwound, right? Because that's something that's being talked about, is that maybe the Supreme Court rules them unlawful or basically forces the Trump administration to unwind some of the tariffs. And so they highlighted 10 stocks that I think would be, that they thought would be, could do quite well. And so what we're going to do is approach those from a technical perspective and see how the charts, relate to some of the comments that were made in that report. Before we get to that, I do want to remind you, by the way, if you want to follow charts like these, tariff unwinding, shutdowns being shut down, and all of the impacts on the charts, you may want to check out my market recap show. It runs every trading day after the close on my YouTube channel called Market Misbehavior. Also, we've had some really good episodes of the Market Misbehavior podcast recently. I sat down last week with Jerry Robinson of followthemoney.com, Stephen Bavaria, author of The Income Factory. Two very different conversations. Jerry Robinson, all about trend following the money, his process going from day trading to swing trading to position trading, and what trend following tools and techniques he uses today, how he thinks long-term in an era of short-term noise. Stephen Bavaria is author of The Income Factory. He talks about how price appreciation isn't all that we should be thinking about. We should be very focused on consistent income sources, not just high-yielding stocks like utilities or consumer staples, things like BDCs and closed-end funds and other acronyms that if you don't know what I just described, you may want to check out that interview with Stephen Bavaria. Some really good stuff. All of that's on my YouTube channel as well. All right, so let's get to the discussion. So basically, what I mentioned in the introduction, Wells Fargo put out a piece where they talked about tariff relief and sort of identified 10 stocks. Now, I can't share all the details of that report, but I would say, the process basically, from what I understand, was focused on stocks that underperformed during those declines in April when the tariffs were initially announced. So the fact that they performed quite poorly right after the announcement of tariffs, the expectation is these are stocks where investors certainly expected there to be some pretty meaningful underperformance. And then also that they cut their second half earnings estimates, which implies that the companies were expecting a hit from tariffs. So the idea is stocks that sold off once the tariffs were announced, and then the companies actually lowered their, had their, analysts lowered their estimates, meaning the street expects the tariffs to be a hit. This is not based on what companies' actual, hit or actual impact of tariff that was described. It's making a lot of assumptions. However, I think it's an interesting working list of stocks, and here they are. 5 consumer discretionary names, which makes sense. I mean, the most logical places that you would think tariffs would hit would be consumer discretionary and industrials. Those would be like the two obvious ones for me, because these are companies that most likely get stuff from outside the U.S., either clothing and products that are created outside the U.S. that you're shipping here, or raw materials that you're shipping in, and in either case, probably going to be be a weight on your earnings. So in the consumer discretionary sector, you can see the chart list here. Gap, Tapestry, Nike, Best Buy, Five Below. One healthcare name, GE Healthcare Technologies. That was one of the spin-off names with like GE Aerospace. Remember, GE split from a kind of conglomerate into a couple different tickers. This is GEHC, which is the only healthcare name. And then the rest of the four are all industrials. Masco, Caterpillar, Oshkosh, and Stanley Black & Decker. Stanley Black & Decker. That's a tongue twister. Ticker SWK. So what we're going to do here is, of course, analyze the charts and go through. And the reason why I'm doing this and why I thought it would be helpful on the show is this is a kind of an approach that I use often. Anytime I read an article in Barron's and on a financial website, and anytime they give like a little listicle article, right? A list of top 8 stocks that are doing blah, or top 10 stocks that had tough, Q3 earnings or whatever it is, I always want to look at the charts, right? Always. And so I have often done this, basically creating the charts that in my ideal world, the person who wrote that article would automatically create these beautiful charts. Because I think unless you evaluate them from a technical perspective, it's hard to really pass judgment as to what the prospects are going forward, right? For me, that is the language that I speak when I'm trying to evaluate a stock. So these are basically the visual aids I think that article should have included with a very technical focus. So what I'd like to do is just show you how you can use the StockCharts platform to do this sort of thing. And the next time you read an article in Newsweek or in Barron's or on IBD or something, and they talk about some stocks and you want to have a better chart book to go along with that article so that you can make an informed decision based on the weight of the evidence in the article and the technical components, I hope you follow this process. So let's go through the charts, and then I'll share at the end how I set this up and how you can do it. So, maybe I'll do it together. So first off, you have to get them into a list. And so what I did was I created a new chart list, and I actually usually do that from my member dashboard. So I'm going to go here. I'm just going to half create it because I already did it, so I don't need to do it again. But I'll go here to ChartLists, click on New ChartList. I'm getting pretty close to maxed out here. I'm going to have to do a little clean house here. And then you call it test 1, 2, 3. And it's as easy as this, right? You just start typing the tickers with commas in there. So whatever, stocks from the article, you can reorder them later. This is just to get the raw materials into a new chart list. So that's what I did. And I got to, this, which was basically the list. Now, it actually came in a different order. So what I did was I grouped them by sector and industry group, which is what I usually do when I'm creating a chart list. I always just get them in there, and then I try to sort them in a meaningful level, a meaningful order. And the two ways I tend to sort my charts are either in sector order, so I can group similar companies together. So I can just get a sense of what sectors were better or less represented, or put them in a meaningful order based on the technical implications, like in the scooter ranking or something like that. And the good news is once you get the stocks in the order, you can immediately sort these tickers by some of the columns here, and you can actually add additional columns that I'm not even showing here onto your summary page as well. So what I did was I sorted by industry and then by sector. And what that does is it basically puts them into order, grouped by sector first and then industry second. At the very bottom, there's this little gray button, which you may never have noticed before. It says number in sorted order. So if you sort these into a meaningful order and then you want to make your chart list in that order, just make sure you click the button. That's what added these numbers here. I always add the S&P 500 as well, just so down the road I can look at performance and I can compare the performance to the benchmark, to the S&P 500. So at the end of a chart list of any sort, after I'm done sorting, after I'm figuring out, I usually add the SPY with 999 as the beginning of the name. That means it's always going to be at the bottom of my list. And I do that just so I can think of, look at the S&P and in terms of performance especially, and make that comparison. Now from there, there's a number of things we can do. Once we get the tickers into a chart list, it's going to use my default chart style, which is what I want to use anyways. But then I can look at the chart list view, which is going to show me all the charts. I can use the RRG and actually look at the relative performance. I could look at the performance table. I can look at all these other ones as well. Let's go through a couple of these just so you can get an idea of what we can do here. So starting with performance, what this allows me to do is start looking at different time frames. So I can see year to date, there's actually quite a performance spread from Tapestry and Caterpillar, both up about 60+% year to date, down to Nike, Masco, Stanley, Black & Decker, all of which are down over 10% year to date. And if you're wondering, the S&P's here currently trading about 17% above the end of December of last year. So this gives me a sense of how, despite the fact that these all took a hit during the announcement of the tariffs, all of them, had their estimates lowered for the second half of the year. There's quite a spread in terms of performance over this period. Now we can look more recently, just look at the last month, and you can see that gap, which is actually one of the more choppy sideways charts that I'm going to show you here in a minute, is actually up 24% year to date. Some of these have actually just gone through Q3 earnings, and that's obviously causing some significant gaps as well. Caterpillar, Best Buy, all up over 10% just in the last month, and that's compared to the S&P 500 up 4%. So anytime I have a list of stocks or ETFs, this performance table is often a place I'll spend a little bit of time just to kind of assess what are we working with here, right? And some of these names I probably know. Like I know the chart of Caterpillar already because I've been following it very closely because it looks pretty good and it's a strong, technical configuration. But Stanley, Black & Decker I haven't looked at too often. So understanding which are working, which are not, how that compares to a benchmark. And now you can probably see why having the benchmark as one of the tickers is quite helpful, because when I'm looking at the performance table, I can immediately separate the outperformers from the underperformers for whatever time frame that I selected. All right, let's assume we spent a little more time there. The second thing I often like to do is look at the relative rotation graph. The relative rotation graph, the RRG, is a visualization technique designed by Julius de Kempener, my friend and fellow StockCharts contributor. Julius is awesome. I've followed Julius's work and have known him for a number of years. Big fan of the RRG as a way of visualizing a bunch of things, in this case, a bunch of stocks on one page. I'm a big fan of visualizations like the market carpet, which is a heat map style visualization, the RRG, which allows me to take a group of stocks and just focus on which stocks are in different sort of, configurations, right? Which ones are showing different trend characteristics. So out of those 10 stocks that we popped on here, what does the RRG tell us in terms of the one very positive outlier, right? Very easy. Your attention should be drawn to the upper right corner, what's called the leading quadrant. Caterpillar, by far the best of the bunch here. Heading northeast in the leading quadrant, strengthening in terms of relative performance and the momentum of its relative strength. All of that's pretty encouraging. So Caterpillar is sort of like the very positive outlier. What are the stocks that are struggling? I can see down here where the RRG has been rotating southwest. SWK, Masco, Nike, Oshkosh. These are a lot of the industrial names, but also Nike, which is, I think, without a doubt, one of the worst charts I'm going to show you in terms of the general trend configuration. We can do different time frames and ways to sort of, dig into the data a little bit more, but I just wanted to point out this is another way that if you have, especially a larger list, this can be really helpful to just say, all right, a lot of these stocks are kind of okay. What are the really good ones? Let me make sure that I understand the strength there. What are the really struggling ones? Let me make sure that I recognize the weakness there. These are the things I probably want to be, leaning into. These are the ones I probably want to be leaning away from because the charts would justify it. All right, so once we've done all that, then I like to dig into the charts. And to be honest with you, this is where we just look at the configuration of each of these charts and think of it like a checklist. Now, we're still grouping this in sector order. So we'll look at the consumer discretionary names, 5 of those. We'll look at the one healthcare name, the 4 industrial stocks, and I'll quickly just highlight some of the technical implications of these charts, some of the indicators or signals that stand out. Now, first off on the chart of Gap. Now, Gap is actually reporting earnings in about 10 days. They're reporting on November 20th. So this is an earnings name. They've not reported their quarterly earnings just yet here. That'll be coming up later this month, that week after NVIDIA, by the way. August 28th, that's the last time they actually reported back here. And as we can see, the stock actually rallied for about another week after that August reporting date. Here was a Gap lower in May, which was the previous earnings report. There was the gap lower in August. So going into that, sort of like late March, early April, big gap lower, we can see a brilliant recovery, but then another big gap lower on earnings. And so that's where there was a lot of optimism coming off of that, April low. The major indexes, S&P and the NASDAQ, obviously rallying pretty aggressively in May. But here we hit Q2 earnings, and this is where, Gap is talking about potential implications of tariffs, estimates lowered, missed earnings, and that's why we have a lot of choppiness. But from there, it's been really a choppy sideways market. I don't think this is a horrible chart anymore. It's not the best chart ever. The best chart in this list, I think we'll look at in a little bit, but in terms of potentially just breaking out, Gap stands out to me. So what I look for on a chart like this, I'm a big fan of looking for new 3-month highs, right? When a stock is sort of in a consolidation phase, when we sort of have a consistent resistance level and a fairly consistent support level, this one's kind of all over the place in the 19 to 21 range. 19 to 20 range, maybe we'll call it. But here we have resistance here in early September around 24.50. We retested that level with a what's called a gravestone doji candle there. End of October, we pulled back from both of those points. We're kind of right back up to retest that high. So when we have a high that's been established, we've had a couple attempts to break out, but haven't done so. That breakout is pretty meaningful. So in this case, I probably set an alert. Tell me when Gap gets above 24.50, or if I want to be a little more conservative, Gap above 25, right? And tell me when the stock actually breaks above that previous resistance. So Gap kind of in what I would say is kind of neutral and trying to break back out of this consolidation phase. Okay, here we have Tapestry, which is another consumer discretionary name. We can see that we've pulled back to a major support level, right? Look at the gap lower in August. So back here, this is the gap that, kind of got it on the list. Big gap lower in early April. We can see the nice, trend higher, but then a gap lower mid-August. They actually just reported earnings last week and gapped lower again. So the last two earnings reports have not gone particularly well because we've had a downside gap. Now, after the August earnings disappointment, it hit the 50-day moving average, kind of rode the 50-day all the way to make new all-time highs and eventually eclipse that peak from early August. So overall, nice setup going into this earnings report. However, just before the earnings report, we actually broke below the 50-day moving average, which is kind of a red flag in my book, right? When we're above the 50-day for a while, then we break below it. That often for me is a sign, it's what we call a change of character. Something's new, something's different, not a good thing. So we did trade a little bit lower. We gapped lower on earnings, but since reporting earnings last Thursday, we rallied. Last Friday, we rallied. And today so far on Monday, November 10th, kind of rallying. So I like the bounce off of support. I like the fact that we've held above the 200-day moving average. With this kind of chart, given the fact that it broke below the 50-day and now it's kind of rallying up, I look for this kind of pattern. We can get back above the 50-day. All right, maybe I would take a shot. Maybe take an initial position to ride a next move lower. The other thing I would say is watch the RSI on this, right? If you look at the highs in September and October, we're making higher price highs on weaker momentum. So showing a classic bearish momentum divergence going into that October peak. I think that's a concern as well. The RSI is more in the bearish range, right? Well below 50. So I don't want to see a break above the 50-day and the RSI pushing well above 50 to signal a rotation back to a bullish momentum phase for Tapestry. Nike's just not a good chart from a technical perspective, and I will tell you why. Just the comment we were making early on Tapestry and the momentum, the RSI now consistently below 50, always below 60, since back here when we made a peak around 80 in late August. From there, the RSI is basically telling us we're in a confirmed bearish trend. It's underperforming consistently, which is a problem for me. The real issue is lower highs, lower lows below downward sloping moving averages. So something like this that's in a confirmed distribution phase, lower highs and lower lows, I want to see a higher low. I want to see the stock, instead of making a new low, makes a high, is unable to make a new swing low. That would be a good sign of an upside rotation for Nike. Until then, I'm happy avoiding it. All right, Best Buy, probably Probably the most compelling chart so far. This is a stock that actually broke out in late August. So after an initial rally in August, Best Buy was big time sideways. Look at this consolidation. Stable highs, stable lows. Broke above that resistance in August. Broke above the 200-day. A couple tests of the 200-day which have held. Now we're making a new 3-month high, which is when this started to pop up on my regular scan for new 3-month highs. I remember seeing Best Buy and thinking, oh, this is really starting to improve. We've now pulled back to an ascending 50-day moving average. This is where the pullback in October stalled out. If this can hold, if the RSI can hold 40, potentially really good buy on the dips opportunity, but that's a big if. We'd have to assume that higher low is going to hold, and that's what I would be looking for there. 5 below, almost the same story, different configuration because this one's been more of a primary uptrend. Higher highs and higher lows, all that's good. The 50-day moving average is being tested. It's been tested a bunch of times here since the end of July. Every one of these has held. As long as it holds, I think that's pretty encouraging. Very much in question right about now. The momentum's actually neutral, but a breakdown of the 50-day moving average in this instance, I think, would be a fairly negative sign. GE Healthcare is very much a sideways chart. I would say GE Healthcare and Gap, which is the first stock that we talked about, I believe, really consolidating, right? So I think of stocks in one of 3 phases. We're in an accumulation phase, higher highs and higher lows. We're in a distribution phase, lower highs and lower lows, or in a consolidation phase, equal highs, equal lows. This is that third phase. The trend is sideways. So for me, it's a pretty easy trade. We wait. We patiently wait. At some point, GEHC above 80, really bullish breakout, because that tells you that we're finally able to eclipse that previous resistance. GE below 70, very negative chart, because that would tell us we've now broken through support, and instead of holding that level, we're getting underneath it. We're kind of trading all around the moving averages, which are very flat. The momentum is neutral. This is giving us all the signs that this is a sideways trend. Jesse Livermore famously said, there's time to go long, time to go short, time to go fishing. This is one of those time to go fishing charts until we get a change. Masco is a breakdown name, reminds me a lot of Nike, breaking down through the 200-day, lower highs, lower lows, weaker momentum, I avoid. Caterpillar, strong uptrend, accumulation phase. This is when I mentioned that earlier, this is what I mean. Consolidation phase in August into mid-September. We break out higher highs, higher lows, above upward sloping moving averages. Get nervous when that's no longer true, but for now, I would say Caterpillar above the 21-day EMA, long and strong, beautiful uptrend. Oshkosh, I think, is the last, two more. Oshkosh and then Stanley, Black & Decker, 2 more industrial stocks. Oshkosh was a very good chart, and this was actually one that did quite well despite all the tariff news and despite the fact that other companies were struggling. Oshkosh actually outperforming the S&P in May, June, July, and August. Made what has now been a major high around 144, 145 at the end of August. And then from there, we broke the 21-day EMA. We broke the 50-day moving average. We sputtered above the 50-day and then resumed this downtrend. For me, it's now in a distribution phase of lower highs and lower lows. I would love to see accumulation. A rally where the RSI pushes above 60 would signal a big rotation there. Too early, I would say, based on the chart. SWK, below the 200-day, below the 50-day. This is actually a head and shoulders type pattern. Potentially, we'd have to see if we break the neckline, which means we'd have to get all the way down to like 62, 63 to complete a major topping pattern. For now, getting back above moving average resistance, getting above that October high, I think would be really encouraging. So for me, it's like a break above 73. I think would clear those moving averages, at least give me an opportunity to think about further upside potential. So there we go, and then we've got the S&P at the bottom. So what's interesting is when you think about that list, and again, this is not a list I created. This is one that came from a Wells Fargo report. I love the idea, this way of thinking about it. This is a great way that I have learned to think about the potential impact of macro factors, right? Tariffs have been announced. All right, and we've now heard comments more recently that tariffs may be unwound to some degree, which means some stocks that maybe were being undervalued because of their exposure to tariffs. Those tariffs starting to be lightened up or taken away, maybe this gives an opportunity for these to start to resume. I think what we found looking at the charts together is this is not a homogenous group of charts, right? They all don't look like Caterpillar or don't look like Nike. There's some very different patterns. We talked about some sideways consolidating names, thinking about resistance and support levels and identifying those, being patient and waiting for the right signal, the right trigger. We talked about strong uptrend names and how to make sure that we follow those trends, looking at the moving average configuration. We talked about really underperforming charts and looking for signs of accumulation, improving price, improving momentum. Higher lows can be so helpful in terms of validating which stocks are starting to change from a distribution phase to an accumulation phase. I hope the main takeaway you had from today is how you can read an article, take a list of 10 stocks, turn it into a chart list, which allows you to evaluate performance, evaluate relative performance with the RRG graphs, and then look at the charts one by one using the chart list features of StockCharts.com. That'll do it for today. I'm Dave Keller with Market Misbehavior. Please check out my market recap show called Chart This with Dave Keller every day after the close on my YouTube channel called Market Misbehavior. While you're there, check out my Market Misbehavior podcast as well. Stock Charts contributors like Mary Ellen McGonigal, Tom Boley, and many others, and a lot of great other guests that you may or may not be familiar with. Good conversations to make you think and improve your process. Have a great one, and remember, it's always a good time to own good charts.